Most people think investing is simple. Buy stocks or crypto, wait, and watch your money grow. It seems like a fair system, where everyone plays by the same rules. But in reality, some players already have the advantage. Throughout history, financial markets have been filled with schemes that exploit ordinary investors. From aggressive brokers to complex financial systems, manipulation takes many forms, but the tactics remain the same. Understanding how these scams work is the first step to protecting yourself and spotting the warning signs early. How market scams typically work. Despite their different appearances, most financial scams follow a predictable structure. They are rarely random events. Instead, they rely on carefully designed strategies that exploit human psychology. The process usually begins with hype. Scammers create a compelling story that promises massive returns or exclusive opportunities. The goal is simple: trigger excitement and urgency so investors feel they might miss out on life-changing profits. Once people show interest, the next step is control. This control may involve limiting the supply of a stock or spreading selective information that highlights only positive developments. By shaping what investors see and believe, scammers create artificial demand. As more investors rush to buy, prices increase rapidly. Rising prices attract even more buyers, reinforcing the illusion that the investment is valuable. But this is exactly when insiders exit the market, selling their shares at inflated prices. When the truth eventually surfaces, confidence disappears. Panic selling begins, prices collapse, and late investors suffer the biggest losses. Some of these schemes are clearly illegal, while others operate within legal loopholes. Regardless of legality, the damage to investors can be devastating. This is why legendary investor Warren Buffett emphasizes a simple rule: never invest in something you do not fully understand. Pump and dump schemes. One of the most well-known financial scams is the pump and dump scheme, a strategy that has existed for decades but continues to thrive in modern markets. The method became widely known through Jordan Belfort, whose firm Stratton Oakmont ran massive stock manipulation operations in the 1990s. The process was straightforward but highly effective. First, insiders secretly purchased large amounts of shares in small, relatively unknown companies. They often used intermediaries to hide their involvement and avoid attracting attention. Once they controlled enough shares, brokers aggressively promoted the stock. They used persuasive sales tactics, exaggerated claims, and constant communication to convince investors that the stock was about to skyrocket. As more people bought shares, demand increased and prices surged. This rapid price growth created the illusion of success, attracting even more investors. At the peak of the hype, insiders sold their holdings for massive profits. Without continued promotion, demand disappeared, prices collapsed, and ordinary investors were left with worthless shares. Although this strategy was prominent in penny stock markets decades ago, similar tactics still exist today. Online communities, social media platforms, and messaging groups sometimes promote hot stocks or digital assets using the same principles. The technology may have changed, but the underlying strategy remains identical: create excitement, inflate prices, and exit before the collapse. Profiting from secret information. Another major form of market manipulation involves insider trading, where individuals use confidential information to gain an unfair advantage. A famous example occurred in the 1980s when investor Ivan Boesky profited from advanced knowledge of corporate mergers. He received confidential information from investment banker Martin Siegel, who leaked details of upcoming deals in exchange for financial rewards. Why is this information valuable? When one company plans to acquire another, it typically offers shareholders a higher price than the current market value. Once the acquisition becomes public, the target company's stock price usually rises immediately. By purchasing shares before the announcement, insiders can secure enormous profits with minimal risk. Boesky reportedly earned tens of millions of dollars using this strategy before authorities exposed the scheme. Insider trading is illegal because it undermines fairness in financial markets. It gives certain individuals an advantage unavailable to the general public, similar to having access to exam answers before a test. Concerns about insider advantages extend beyond corporate executives. Some critics argue that policymakers could potentially benefit from knowledge of upcoming regulations that affect industries. Although laws require public officials and corporate leaders to disclose their trades, this information often becomes available only after transactions occur, limiting its usefulness for ordinary investors. When the entire system becomes risky. Sometimes the problem is not just individual fraud, but widespread risk taking across the entire financial system. The global financial crisis of 2008 is a clear example of how systemic practices can create massive economic damage. In the years leading up to the crisis, banks issued large numbers of home loans to borrowers with weak financial backgrounds. Traditionally, banks would hold these loans and collect interest over decades. However, many institutions sought quicker profits. Instead of keeping the loans, banks sold them to financial firms. These firms then bundled thousands of mortgages into complex financial products known as collateralized debt obligations. Collateralized debt obligations combined both low-risk and high-risk loans into single investment packages. Credit rating agencies often assigned high safety ratings to these products, leading investors to believe they were secure. Financial institutions also created instruments called credit default swaps, which functioned like insurance against loan failures. Investors could bet on whether borrowers would default on their mortgages. The system encouraged excessive risk-taking. As housing prices rose, many assumed borrowers would continue repaying loans. However, when homeowners began defaulting, mortgage values collapsed. The failure spread rapidly through the financial system, triggering a global economic crisis. The event demonstrated how complex financial structures and widespread optimism can create dangerous market conditions even without a single mastermind orchestrating a fraud. Why market scams continue to exist? Despite regulations and enforcement efforts, financial scams continue to appear. The reason lies largely in human behavior. People are naturally attracted to opportunities that promise quick wealth. The idea of easy money creates emotional decision-making, often overriding caution or rational analysis. Additionally, many questionable practices operate in legal gray areas. Certain activities may appear unethical but remain difficult to prosecute. For example, individuals may exploit legal loopholes, use indirect transactions, or rely on complex financial structures that obscure responsibility. Financial innovation also plays a role. As new technologies and investment vehicles emerge, regulators often struggle to keep pace. This allows new variations of old scams to develop. Ultimately, as long as markets involve risk and human emotion, opportunities for manipulation will persist. How investors can protect themselves. Although market manipulation cannot be eliminated entirely, investors can reduce their risk by following several key principles. Diversification is one of the most effective protections. Spreading investments across multiple assets prevents a single failure from causing devastating losses. Investors should also remain cautious of sudden price increases without clear explanations. Legitimate growth is usually supported by strong business performance or major developments. Rapid price spikes driven solely by hype may indicate manipulation. Another important rule is skepticism toward guarantees. Any investment promising extraordinary returns with minimal risk should raise immediate concern. Historically, many major financial disasters began with claims of safe and guaranteed profits. Finally, education remains the most powerful defense. Understanding financial markets, investment strategies, and common scams helps investors make informed decisions rather than emotional ones. The reality of modern investing. Financial markets play a crucial role in global economic growth, but they are not always fair or transparent. From pump and dump schemes to insider trading and systemic financial risks, history shows that markets can be manipulated in various ways. However, these schemes share a common structure, create excitement, influence perception, and exit before others realize the truth. Recognizing this pattern allows investors to identify warning signs early. The most successful investors are not those who chase every opportunity, but those who understand risks and make informed decisions. As Warren Buffett famously suggested, learning from the mistakes of others can be more valuable than learning from your own. In a world where financial opportunities constantly evolve, awareness remains the strongest protection. Understanding how market scams operate may not eliminate risk entirely, but it can help investors avoid becoming the next victim. If you enjoyed this deep dive and want more videos exposing hidden systems behind money, markets, and power, make sure you like and subscribe. Thanks for watching, and we'll see you in the next one.